Welcome back to BetterWealth Reacts. Today, I'm going to be reacting to Is Infinite Banking a Scam? It's a video that our team put in front of me. It's by Pocket Watchers, and I actually watched a couple of his videos. He does a lot of call-in shows. People interact with him. He's very strong in his opinions, and he's passionate, and it looks like he's a CFP and a financial planner, and he has some very passionate views on infinite banking. I watched this video once. I'm going to watch it again with you. We'll stop when I want to make some points, and then at the very end, I will give you my 2 cents around do I agree with what JT is saying, and what would I do a little bit different. So without further ado, let's jump in.
Infinite banking is a scam. Change my mind.
All right. Well, I'd like to first say I'm 24 years retired military.
All right.
And I had term insurance under SGLI the entire time that I was in the military. Mm-hmm. So what got me to looking at insurance was because that SGLI had to go into VGLI, which is for veterans insurance. Mm-hmm. So I had to go and look for insurance for myself and my family.
Okay.
So what I ended up doing was researching custom whole life and traditional insurance, what have you. So what I ended up doing was eventually I worked for New York Life for about a year.
Okay. So did you become an insurance agent?
A producer. I became a producer for a little bit.
So when you said.
So New York Life is one of the top major 4 mutual companies, and so just for context,
producer. I know what it means, but I want the pocket watcher. What does producer mean?
It's an agent.
Okay, so that means the way that you made money was selling people insurance policies.
No.
How did you make money?
So the reason that I got into it was
I'm not asking you that. I'm asking you very specifically. How did you make money?
Well, I'm retired.
No. Let me be clear. Maybe I'm speaking another language. When you worked for the insurance company, how did you make your money?
I did not. I'm trying to explain it to you.
You didn't make money. Did you work for the insurance company?
Yes. So this is what happened.
So you worked for the insurance company, but you made no money when you were working for the insurance company.
I made no money. So let me explain how that works. Because insurance producers are paid on compensation. They're not paid like a normal salary or anything along those lines. So when you go in there and you say, okay, well, you can sell insurance policies, you can sell annuities, you can sell
So a commission? So a commission? A commission?
Yes, sir. Yes, sir.
Okay,
that's getting paid.
A commission on what? A commission on what, sir?
Like I just said, if you sell insurance, if you sell annuities, you sell any other financial products under New York Life or any financial institution, you're paid based on compensation.
Compensation of what?
Commission. Off of those
so you got paid when
no,
you
sir.
sold.
I did not get paid, sir. No, sir. Okay, so the reason I didn't get paid is because I was only temporary involved in it. So you don't get paid unless you sell something.
So you never made money. You never made money.
I never made any money.
How long did you work there not making any money?
6 months.
So you worked there for 6 months not making any money. This is a great story so far. Please continue.
So the way that I make my money, like I said, I'm retired.
No. I understand that part. We're talking about the time when you were working at the insurance company.
Got it.
Yeah.
So I made zero money. So we're clear, correct?
You apparently. I mean, it's your story.
Got it. So what else?
So first of all, this makes my head hurt so far. I think this could be so simple. What JT, and I've seen him do this in another video, he'll ask right away, like, hey, do you make money? Like, do you make money selling insurance? And if someone says yes, I'm not saying he uses it to discredit, but he rightfully just points out that's like, hey, you make money selling insurance, so somehow your credibility should be less, which I totally get that mantra, because it's anytime someone makes money by, saying something, you know that there's bias there. So I get where he's coming from. This other person, I think, was maybe a little bit confused, or maybe was trying to point out the fact that, he didn't make a ton of money, or clearly he didn't sell anything. And that doesn't necessarily surprise me, because over 80% of the people that get into the insurance space make nothing and they get out. And so not shocking, but a painful first couple minutes.
You need to know.
That's it. You worked for an insurance company and you made no money.
Made no money.
Okay, but let's do a hypothetical.
Okay.
If you were to have made money, how would you have made your money?
By selling any of the products, insurance,
I said, right.
X, Y, and Z.
I would have been correct when I said you made money, or you would have made money based on the position.
You were correct.
Based on your position, you would have profited by selling people insurance.
Correct.
It's just that you didn't sell anybody any insurance.
I didn't sell anybody insurance. Correct.
Oh.
Honestly, bro, I mean, we all that stuff you just should have said, yeah, I was an insurance agent. I didn't make any money because I didn't sell any insurance. But my job position was that of an agent that makes money off of selling insurance. I mean, we really went a long way around the block to get to this point.
I apologize.
Well, at this point, I just want to let you know how you look. It seems as if you're dodging the direct question. So now the rest of what you're going to say, people are going to be squinting a little hard with what you say. So first impression is everything.
Got it. Go ahead.
All right, but go right ahead. Change my mind.
I watched another video recently of Dave Ramsey talking with a individual who sells life insurance, and the way that individual brought up to Dave Ramsey was in a very humble way. And you could see Dave Ramsey, out of all people, who jumps on people, took it with a lot of grace, and it was like a great call. And I think there's a lesson to be learned where it comes to being upfront, but to also play devil's advocate. JT is, and you'll see this throughout the video, is like very much like very reactionary, or like trying to like really punch back. And I think that can also make it difficult when you're trying to have a connection or talk to someone, and someone's constantly trying to like debate you. It makes for a choppy call, which I think you'll see that this call is choppy, and you'll again get my final thoughts on what I would have said or how I would have directed the call. And my hope is that I get to talk to JT sometime, and maybe we can have like a real sit down conversation where it's not a I'm right, he's wrong, he's right, I'm wrong. It's a conversation to see if there's any points that we can agree on, and then work backwards from there.
All right.
Go ahead.
All right. So basically what you're saying about infinite banking is incorrect. Because when you put money into an overly funded, specially designed.
What do you mean by overly funded? Break that down.
So every month you have either a monthly, quarterly, or annual premium. So
a premium for
your policy.
Okay.
For insurance.
All right.
And let's say my age is 46 years old, so my premium is $3,500 per year.
Okay.
Right.
So what are you getting for that premium, sir, versus a term policy?
It's a custom whole life. What are you getting for that? You're getting death benefit. You're getting a death benefit, and you're also getting access to cash value, which under contract is guaranteed to pay a compound dividend of 4%.
How about that? Okay. All right, let's break that down just for a second there, sir. So you're building up a cash value based on what? Where's this cash value coming from?
That's coming from my money.
From you. It's your money already.
It's my money already.
So the insurance guys are granting you the ability to access your money.
Grant me access. No, not to my money. It's other people's money. So let me make it clear. My cash
other
value,
people's money. Okay.
My cash value is my cash value.
Okay.
So any dollar that I put in there is going to go to the cost of insurance, and then the rest is going to go to the cash value. So the money that the insurance is so graciously lending me is other people's money.
By the gift of baby Jesus, they're giving you the ability to have access to your money.
Not my money, sir.
What? No.
Whose money?
Whose money is it? How was the cash value created? Was the cash value? No, time out. Was the cash value created by other people paying their premiums?
No, cash value.
Cash value is made up of you paying your premium. Is that correct?
My cash value is made up of my premium only. Period.
Gotcha. Okay. So tell me again, you're borrowing.
And this is where we got to be careful with language, because the guy on the other phone is technically correct. I would say technically correct in air quotes, because it's the insurance company's money. Well, because you're lending against your cash value. But what JT's saying is like, hey, listen, like you're saying that this is the best kept secret, but like there's nothing special. It's like you have a percentage of what you've started to pay, and which both is correct. So I'm just letting you know, like this caller technically correct, JT technically correct, and so they're kind of going around in circles, which is the theme of this call, by the way.
So based on the amount of cash value that I have, let's say
that you gave the insurance company.
That I gave the insurance company. You're buying paid up additional insurance. That's why I said.
With what? What are you buying it with?
More of my money.
More of your money.
More of my money. So
keep it going.
So I pay my premium, and then I overfund that policy by buying paid up addition.
With more of your own money.
Of my own money. Yeah. So now I have a cash value of $10,000.
Okay, real quick before we get to that point, how long did it take you to get to that $10,000 cash value, sir?
Immediately.
You got cash. So if I put $1 in.
Right. How much did you pay them to get that $10,000 cash value, sir?
I paid them the $3,500, which is my premium, and then I paid an additional $10,000 on top of that.
Okay. What? That sounds like a deal.
Right. So if I did it, I don't even need an insurance company to do this. I'll just do a deal with Orlando. Hey, Orlando, listen, bro. I'm gonna give you $13,000. Would it be okay if I borrow $10,000 from you?
100%.
100%.
I think it would.
Okay. So now,
keep it going.
Now I have $10,000 cash value. That's 90%.
Now remember, you had 13,000.
I had 13,000.
You had 13.
I had 35 actually. I had 35.
So now you got 10.
Because the insurance company will let you borrow up to 90% of the cash value that you had inside your policy.
All right, so let's take a pause here. Just 1 second. Now the $3,000 that went towards insurance. Okay, $3,500. Let's just say that the $3,500 that went towards insurance. Great. Then the extra $10,000 that used to be in your bank account is now with the insurance company. Okay, and now when I want to borrow my money, they'll let me borrow $9,000 because that's 90% of the cash value. Well, if I just kept my $10,000, I have access to the whole $10,000, sir.
Okay, sir. Let's go with your argument.
Am I correct?
Let's go with your argument.
Am I correct?
Yes, sir. You're absolutely correct. Let's go with your
So
argument.
I just gave up the right to 10% of my money.
No, sir. No, you didn't. That's why.
Actually, more than that if you want to play technical, because you gave up, because the original amount was over 13,000. So you gave up a lot more than 10%, but you get the point. And this is, by the way, this is what happens when you get super technical right away and you're trying to like talk to people in like features and benefits. Like, listen, if you are in the industry and you're talking to people and you're trying to sell them whatever you want to sell them, and you're talking about PUAs and loan, it's like, this is what you sound like. And then vice versa, if someone's not willing to start with the actual problem and asking the question, what are we trying to accomplish? And you're just telling me about a strategy, you'll see that it doesn't go super well. And I've seen lots of these conversations, because when you just interact with people, you understand that many conversations can end up this way. And so this is not something that I'm like hearing for the first time, but it for sure is painful listening to this.
Let's go to your analogy.
Within the framework of what I just said, using the information that you gave,
yes,
I just gave up access to 10% of my own money.
No, you didn't. I'll explain
You
why.
said you can only borrow 90% of the cash value.
Of the cash value.
Right, and the cash value you said was $10,000.
$10,000.
So if I can only borrow 90%, which is 9,000, what happened to the other 1,000?
Your 10,000 actually remains there.
No. What happened? Do I have access to that other $1,000?
If you close out the policy, yes, sir, you do.
Oh, but how could I have the policy? Think.
Listen.
If I never had the policy, I've always had access to the 10,000. Sir,
Exactly.
Let's go.
More.
Listen. Make your next one your best one.
All
I'm
right.
gonna give you 2 minutes straight. Make your next one your best one. Go right ahead.
So now the $10,000 that I have in cash value, I can turn around and borrow 90% of that. So I can take out $9,000. Then I can turn around and spend that money on investments X, Y, and Z. Right. Now the next time that money is outstanding, I don't necessarily have to pay that money back initially. I could wait a month or 2 months, save another $10,000. So now I pay back money. Of my own money.
Of your
and
own
now
money.
I pay back.
You're giving them 20.
I said 2 minutes, sir. I said 10 minutes. 2 minutes. 2 minutes.
Go ahead. Go ahead.
So what the policy gives you is the opportunity to earn dividends on the money that you have in the account, in the cash value. So in the sense that I keep on putting money into that account, I'll keep on earning dividends on that money, compounding dividends. So
compounding dividends. Okay.
So I never lose the opportunity.
Let's talk about these compounding dividends. Are these dividends taxable?
They are not.
Oh, really?
Because you're overpaying?
We're gonna get there. We're gonna walk this one down slow. Because I know you know it, Orlando.
I know.
Let's not spoil it for the pocket watchers. Let's walk this one down slow.
All
right. So the dividends are not taxable. Why are the dividends not taxable, sir?
Because New York Life is a mutual insurance company.
It's a return of premium.
And you're part owner of that. So it's essentially them and you are owners. So that's just money return. So it's basically
so what it is, pocket watchers.
He went fast.
Right. What it is not really a dividend. The IRS has already classified it's not a dividend. You didn't earn new money. They're just giving you a refund of the money you already gave them. Because if it's new money, it's taxable. New money is almost always taxable. Unless you put money in a Roth IRA or something like that, the growth money is not taxable. But in the situation we're talking about right here, this dividend, this compounding dividend, the IRS looked at it and said, this ain't new money. You're just giving them a refund off the money they already paid you. That is why the IRS does not tax you on this dividend, sir.
So
am I wrong?
What I'm saying is that
am I wrong?
No, you're not wrong.
You got that wrong.
Yeah, and here's the thing. You're not wrong, but there's a point, and if you watch any of our content, you know that we go deep into the ins and outs and all of this. And the reality is you'll get to a point where a policy is earning your IRR, your internal rate of return, is far greater than what you've put in. And so, yeah, early on, when it's not necessarily making any money, it's a return of premium. You can totally say that. And then over time, like your policy is actually growing at a greater rate, and dividends are also tax-free. And so, yeah, just because in the tax code it's considered return of premium, that's actually a good thing. And so you're getting super technical by saying like, oh, because the IRS says that this is a return of premium and tax-free, like that proves our point that this is a scam. We'll finish this.
Come on, man.
But at the same time,
I'm telling you, I know what I'm talking about here, man. Why did you call it a dividend as if you're getting new money when you know, because I just explained it and you agreed that the IRS looked at the situation and said, these people are not making money. They're only getting a refund on money they already gave the company. Why would you refer to it as a dividend as if people...
If that's the case, then there should be no actual earnings in a life insurance policy. And while some people don't actually earn anything, and you know that I'm not for most people selling life insurance to most situations, there are life insurance policies that there actually is a interest rate above, like you're actually earning interest. And so that whole fallacy, like that doesn't really hold water, quite frankly.
People are making money.
That's contractually guaranteed. On page 2 of the contract,
Stop
it's
it.
guaranteed.
Stop it. Answer my question directly. Is it new money or is it old money?
The breakdown is not.
Is it new money or is it old money?
It's old and new money.
No. What does the IRS say? Does the IRS call it new money or does the IRS call it old money?
The IRS does not recognize it as new money.
You goddamn right they don't, because it's just a refund of your old money. I appreciate you attempting, sir. It was fun having you on the show, and I'll welcome you back any other time. But I'm sorry, you did not change my mind. Lord have mercy. Is this the best we got?
What more?
No, and JT, if you want to have a conversation, whether I come on your show or we do a joint thing, I'm not here to try to change anyone's mind. But it definitely, I think here's my 2 cents before I give like how I would explain infinite banking. So cent number 1 is the caller not the greatest performance, but in your defense, like when you're already on your back toe or foot and you're trying to justify and you're trying to kick back, it's really hard. I mean, it would be easy for me in my studio to be able to say, this is how I would go about it. When you're talking to someone who's like in your face and like really trying to call you out by, first of all, like how you make your money and trying to potentially discredit you and get in your face, like, especially if you don't do content or if you're not used to that, it can fluster you. And so whether the intention was to, talk about the, PUAs and borrowing it's a bad look, because it's like, yeah, what's the point? Like, why would I do any of this stuff? Why would I put my money in and have less early on? Why would I pay? We didn't even cover that, but they alluded to that. Like, you have to pay to use your own money. Like, why would you do that? And then the dividends, it's like, well, the dividends are a return of premium, and so it must be a scam, which the whole idea is like, if you look at an illustration over time, even if you stop paying your premiums, JT, and you have more money than what you've put in, the dividends are still tax-free. And so you could say that's a return of premium, but like, it's what's a return of? If you've put in over time, let's just hypothetically say $100,000 of premiums and your cash value is more than $100,000 and your dividends are continuing to pay on that, you can say that's a return of premium and it's not taxable, but there's more than what you put in. And so that argument on the other side is like, okay, I don't love that, because we're talking like we're so in the weeds, and we got to zoom out and say like, should we even be in the same forest? Like, should we be in this pasture? Because we might be in the wrong pasture. We're trying to debate technicalities, and it's like, at the end of the day, let's zoom out. And it was talking about infinite banking, and the word scam is a really strong word. It's like, it's definitely not a scam, but it might not be a fit for everybody. And for those of you that have seen a lot of my content, you know that is not something that I recommend most people do. And there's people in the life insurance space that they're like, man, you should be more passionate about this. It's for videos like this that I'm not like, this is the best kept thing for every single person, because it's not. But if I were to explain infinite banking, we first of all have to zoom out and ask the question, what are you trying to accomplish? What are you trying to accomplish? Like, when you do something, you all know, or those of you that have watched some of my videos, you know that I reference the word efficiency a lot. And the concept of efficiency is removing any friction to get to where you want to go. And so when you're working with somebody, or when you're trying to figure out what you need to do, you need to figure out, number one, where do you want to go? What do you want to accomplish? What does financial success look like for you? And if you're trying to get to a destination, where's your destination? And then what you have to do is you have to then look at anything that's in your way. You might, if I have to get to across the country, how am I going to get there? What's in my way is the distance between where I am, where I need to go. If I need to accomplish this goal, what is getting in my way? And when it comes to finances, what is the friction that's getting in my way? Is it money? Is it time? You gotta list all of that out. And then at the end of the day, if we can accomplish the destination or the goal the best way, that's what we should do. And so I don't love when people are saying, well, this is better than what most people are doing. Well, I want the best. It's like, BetterWealth is a decent name in my opinion, because we want the best. I want the best way to get to the destination. And so whenever we're talking about that, the first thing is we got to figure out, what are we trying to accomplish? And at the end of the day, financially, like you guys know that, intentional living is really big for me. You're not wealthy if you don't live intentionally. I would encourage every single person to get really crystal clear. What does intentional living look like for you? Really figure out, like, from a value standpoint, and figure out what that is. What does that mean to live intentionally? And make that the trump card. No matter what I say or JT says or other people, like, make sure that living intentionally is the metric. But then we also have to ask the question, like, what's financially the best way to accomplish that? And what you'll find is cash flow is one of the most important metrics to look at. Cash flow. Cash flow makes the world go round. Cash flow is, when we talk about retirement planning, we should really call it future cash flow planning. I'm planning for a future date where my work, my assets that I got, all these things translates into future cash flow. Now, there's two ways that you can get to that destination, two basic ways. Basic way number one is to earn money, spend less than you make, and then invest that money into some type of investments. It could be the stock market, it could be the ETFs, it could be any type of investments, but let's just say, like, the purpose of those investments is to not touch, have it grow over time, and then when you hit 55, 60, 65, 70, 75, those assets are in a place where you can be able to, take income, future cash flow. Now, we're not going to get into this, but the 4% rule, blah, 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 that's essentially saying whatever your dollar amount is, you could maybe take out 4% pretty safely with chances of not running out of money. With proper planning, you could get that number up. But that's like scenario number one. And so the question would be, not infinite banking, but the question would be, does life insurance help person that wants to do scenario number one? Person that's making money, is investing for a future cash flow date in maybe traditional accounts like the market, ETFs, Roth IRAs, 401ks. Does life insurance help that person do what? Have more cash flow in the future? Because at the end of the day, protecting your family is important, but you can do that with term insurance. You can buy term insurance, invest the difference like what everyone says, and accomplish that. So that's like protection's key. I don't think JT would even say that don't be insured, but the key thing is, in the future, what gives me the best result? And so we could talk about, like, does life insurance become a better bond alternative? Does it enhance your cash flow? Does it give you that result? And and we could have a conversation about, let's look at scenario A, buy term, that's the difference, and you get to retirement, and then what's your distribution strategy? You're doing this, okay. And then, let's say you overfund, max fund, whole life, and for a portion, invest the difference. Your investments will be smaller because whole life and investments will get you a net smaller return than if your money was all in the stock market. That's just, like, historically, like, I'm not going to argue that whole life is going to outperform the market. But then the question is, does a smaller number over 30, 40 years, does it produce more cash flow? And you might say, like, that's a dumb question. Of course it's not. Well, not all numbers are created equal. And a person that has maybe a more diversified portfolio or has more options might have the ability to take out greater income without having all their eggs in one basket. That's why some people don't put all their money until retirement into an ETF. A lot of times there's diversification. And I think there is an argument to be made where life insurance could play as a better bond alternative. That's a conversation that you could have, and you could look at that, and then you could say, okay, if I was going to diversify into bonds, and I get the whole concept, and life insurance would potentially give me a better return if you look at not just the rate of returns, but the tax benefits, and then you look at the other benefits that life insurance gives you, creditor protection, safety, and all those other things, and you might be able to say, like, oh, well, this actually would be a better bond. I would be very much willing to argue that and debate that from a standpoint of life insurance being a better bond alternative for a portfolio. And then you could have to say, like, well, if you were funding that, is there a world where you could maybe pay less to term insurance if you had some of your bond alternative is protecting your family, and some of your bond alternative could give you access to capital throughout your life? It's not something that you have to do, but it's available to give you. So that would be the route that I would take for so many of you, that it's like what you're doing is you're making money, you're investing that money, and you're investing for a future cash flow date, and you want to make sure that you have as much certainty as possible. And then the question would be, does life insurance, not infinite banking, but does life insurance for a portion of your portfolio, give you a better outcome. That's scenario number one. Hey guys, I just wanted to interrupt real quick. If you're watching this and have an indexed universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track. I want to know if this is set up properly. We at BetterWealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode. Scenario number two is for the person that is an entrepreneur, is a person that is maybe is an investor, and your greatest need is money, and you are looking to deploy that money, invest that money in your businesses. You're looking to invest it in maybe future businesses. You're maybe looking at to employ in real estate. And so what you're doing is you're making money, you're putting it into a high yield savings account, and hopefully some people put it in a checking account, but hopefully it's in a high yield savings account. And then you're looking for places to deploy that capital and use that money. And for someone like you, you would want to, the conversation would be, we have to compare it to a high yield savings account versus a life insurance policy. And there's pros and cons. High yield savings account gives you early liquidity. So like even what JT was saying is like, this person had $13,500 that they funded into a life insurance policy, and they have an immediate, in this scenario, $9,000. So any rational person would be like, well, where did the other $4,500 go? And it takes years. If you set it up properly, it takes years to have more money than what you put in. And so a opportunity cost, and the definition of opportunity cost is what you could have done with that money is, there's in the first couple of years when you come to infinite banking, there's less money than what you put in. That's a real step back. That's a disadvantage, because if someone in a high yield savings account or a checking account would literally be ahead for the first couple of years by not even introducing life insurance. Now, if that person was doing term insurance, obviously they would be paying the term insurance expense, but that still is going to be less. That gap is still going to be less than if they did the whole life insurance. Now, there will get to a point that over time, the life insurance policy, from just a cash value standpoint, just a actual growth, and yes, JT, that means factoring in all the commissions and everything. Internal rate of return means the actual rate of return. You're going to get anywhere from 3.5% to 5.5% actual growth rate. This is not dividends. All these dividend rates, they can be super misleading. I look at the actual growth rate of a policy, factoring in everything. Okay, so 4.5%, 5%, not going to change your life, not going to outperform any investments, but that's kind of rate of return long over a long period of time. And if interest rates stay where they are, the what I said is probably on the low end. And so with that, they over time will grow greater than a high yield savings account. But that's even without factoring in the tax benefits. And when you factor in some of the tax benefits and stuff, you're going to bump that up, because in a life insurance policy, you don't have to pay taxes. And so there's other things that factor in, because in a high yield savings account, you actually have to pay ordinary income tax on your interest, which sounds crazy, but it's just, that's how it works. And so when you factor all that in, let's say life insurance gives you a 5 to 7% rate of return when you play the devil's advocate tax game over a long period of time. Still not going to outperform many investments, but it does allow you to be able to borrow against that to invest in hopefully other assets. Now, the common question would be, that is a dumb idea. Why would I borrow to use my own money? And technically, this caller was trying to point that out, and may or may not have done the best job. But again, he's trying his best with the environment he's in. And the reality is, you're not borrowing your own money, because then you wouldn't be getting any of the benefits. You are borrowing the insurance company's money, to be technical, and your cash value is staying in the policy and getting all the benefits. Now, here's where I disagree with a lot of my friends in the industry that are just like, there's amazing arbitrage and this makes a ton of sense. Financially, if you don't care about insurance, if you don't care about the death benefit, you don't care about the creditor protection, the safety, and all these other benefits, that the living benefits and the permanent death benefit that increases, if you don't care about any of that, infinite banking is a dumb idea. It really is. It financially you may squeak out 1% arbitrage if you factor in taxes and all that stuff, maybe 2% if you factor in taxes. But over time, it's just not worth the headache if that's the only thing that you care about. But if you factor in permanent death benefit and the chronic illness riders and the creditor protection and the safety and all the other benefits that you get, the fact that you get to protect your family, get all those benefits, have your money compound for the rest of your life, and you get to use your capital while you get the benefit of that compounding, that's beneficial. And my answer would be is if we're comparing to person A, which is the person that does high yield savings account by term, invest in their businesses and does their thing, they're ahead financially. And let's say that they did the responsible thing and bought term insurance for the next 30 years. They're covering their family, they're doing certain things. But there's going to be a time when person B, who's, a little bit behind in the first, let's say 5-6 years, over time, their system is going to be financially more efficient than the high yield savings account, but it's also going to get a lot of other benefits that person A doesn't have. And there will get to a point where, 30 years in, where person A drops off their term insurance and now has all these assets. This person has, let's say, most of all those assets, because there's a little bit of opportunity cost in the first couple of years, not having all the money that they've had. They get all those other benefits. And my question would be, does person B, do they have more options? Are they in a better financial situation than person A? That's the question. And I would say that person B is in a better financial situation, even from the get-go. Even from the get-go, you could argue that person B, even though their liquidity is a little bit down, they could be having other benefits that benefit them. Now, that could be a stretch. And if that is a stretch for someone, you're going to realize whether you work with a company like ours or somebody else, like I'm never saying that someone should over leverage or put too much money. I'm always saying start small, get this thing started and see how this works. And I think that's another mistake that people make is they talk about all the talking points and they're like, let's go all in. And you should never go on in any one strategy, but especially when it comes to insurance, you should never have insurance be something that makes you less safe by having it. So to answer the second question around like if your path is not just put your money in the market or in investment accounts and have a future cash flow, and you actually are an entrepreneur or you're someone that is looking to invest, you have to look at, okay, your money's always got to reside somewhere. Where's the benefit there? You got to deploy that money. Hopefully you're buying assets and other things. And the question would be, is life insurance and those activities going to give you a better result from a cash flow standpoint and what you're looking for long term? The answer for me and a lot of our clients is yes, but the answer for most people that are on YouTube, the most people in America would be no. It would be not a great strategy for you. And that doesn't mean that it just means like there's got to be an investment in the knowledge of why this asset, and then there's also got to be the means to be able to fund something like this to actually make it make sense. And when you look at most people aren't able to save anything. And so if that's someone like you, the last thing I would say is the first place that you should put is in life insurance. First place that I would suggest is in a high yield savings account. And you could also make the argument of maybe putting that money into a Roth IRA and all, not investment advice. But that's where I think the infinite banking or life insurance pitches can fall flat on their face, is they're usually saying that this is better than investments, and they're usually making talking points. And I've heard pitches that literally make you think that the stock market is trash and that insurance is going to outperform it. And in the past, even if you look at the And Asset book, I look back in time, and when you factor fees and all these things, you could make the argument that insurance could outperform or perform just as good. And as I reflect on that, I go, I understand why I wrote that, because that was, a big, like that's when I was learning about all this stuff. This was like a big deal, but I was like, I just don't love that. I don't love that argument anymore, because I think it really does hurt our credibility long term when you're working with people that really know how investing works. And so that's my final thoughts. JT, I would love to have a conversation. We'll be reaching out, and it would be awesome to connect with you, have a conversation. I'm not saying we need to agree, but I think we'll agree on more things than we disagree. I also want to do some type of call-in show and figure out how to pull that off. And so would love to hear just what you've learned in just your journey of being able to do that. And I also love to hear from you. What did I miss? What do you think I could have explained better? What are your thoughts on how JT and this other caller interacted? And please send us more videos to react to, because this is fun. It's fun for me to see what other people are saying and give my 2 cents.